All right, let's get an idea. Let's see that in QuickBooks. So I can say over here and say, let's imagine we enter like an expense form. So I'm going to enter an expense form and I'll do it for, let's just say Verizon again, Verizon tab. We're going to add that. It's going to be a check type form. And let's say that we do it as of, let's say it's in 2025. And then we'll say the method is, I'll just keep it blank on the method. I don't need one. And then I'm going to scroll down and say it's going to go into the telephone expense, boom. And let's just do our classic 150. So this is an expense form, which is kind of a type of check form, decrease in the checking account. The other side go into telephone expense. Let's record it. We'll save it and close it and say, okay, what does that do? If I go to the balance sheet and run it, then of course in the checking account, if I drill down on the data in the checking, we should have a transaction. Let me refresh it here. There it is. So there it is, decreasing the checking account like we would expect. Let's go back up and back. Let's go into the profit and loss, run this report, and we can see it down here in 2025. There's the 150 telephone. What did that do to net income? It brought the net income down. So the net income for 2025 is now a negative 184. That's a loss. We can see how that's connected to the balance sheet because that rolls in to the balance sheet over here. And so there it is, the 184. So that helps us to basically be in balance. And so it's already been recorded. So if we filed the taxes, let's imagine for 2025, and it was done, then we would have taken this deduction in essence of the 150, and it would have rolled into our retained earnings. So if it now, let's imagine we go into 2026 and I void the transaction, it's going to mess up what I already recorded on the balance sheet. So let's imagine that. So I'm going to go back on over here and say, okay, now let's imagine that we're going to void that transaction. Oftentimes you could do this multiple ways. I could go into here and I could say, let's go into it from the checking account and let's go into the transaction. What did I go into 2024? Let's go into 2025 checking account and we could go into that transaction. And then I could void it here. So we have the void right there. But oftentimes we do this like in the check register. So if I close this back out and I go back and imagine that I was reconciling. So I'm going to go to the transactions. And when I did my reconciliations for the bank reconciliations, then I would say, oh, wait a sec, this transaction's been outstanding all year for 2025, and I'm now in 2026. We're imagining I need to get rid of it, right? It shouldn't be there because maybe it was entered 2 times, and so it's never going to clear. Okay, so one way I can do that is I can go into the chart of accounts. This is one way to get to the register. I'm going to close up the hamburger. Checking account, you can see on the right-hand side, you have a view register. This looks kind of like your checkbook if you had the old checkbook. And so it's just another format to see these items. There's the bill that we entered. Again, I can go into it here, and typically I still have to edit it. So notice you have the delete button. We don't want to delete it. That's going to be the first thing. When you go to edit to avoid it, you're kind of doing the same thing as deleting it, but at least it gives us the audit trail. So it's going to enter a transaction. So voiding it would be better than deleting it, although we still have a problem. So I'm going to void it instead of deleting it. So I'm going to say, all right, void it. And it says the transaction will stay in your books, but the amount will go to 0. Okay, void that. So now when I look at it, I can say, okay, there it is. That gives me a little bit of indication of what's happening. So if I go into this transaction, I see it as basically voided. So that's cool, and you can see it's voided up top. The problem with that is that when I go to my balance sheet, I'm going to run the report, and in 2025, that amount has been removed. If I go to my income statement, it's been removed. I'm imagining I'm currently in 2026, But when I go into my 2025 net income, it will no longer match what I reported as net income in 2025, such as, for example, on my tax return, for example. So that means it's not rolling over properly. So the next step is I have to go over here and say, and this is something I should have done before I voided it so I can make sure I see the dollar amount. So I would say as of the same date, I'm going to enter another transaction, and I'm going to say, let's say a new transaction here. And we're going to go, and sometimes I'll try to record these like as a journal entry. So here it is. Here's the little drop down for the transactions, because that'll tell me that it's kind of an adjustment. I'm going to make it as of the same date, which was 3/1/2025. And I'm just going to put it back on the books. So it's going to be telephone, what did I say? Verizon, and boom, memo, void, check, and then I check for 1/3, and then I'm going to put it back on the books for, what did I say it was? 150, I think it was. Let's just do the 150, and then it's going to go into the telephone account. Telephone. So now we just put it back on the books with a journal entry. So let's see what that does. If I save that and I go into my balance sheet, and I run it again, and then now I go into my checking account, boom, checking account. I see here that I have the expense form, which has been voided, but then I have the 150 back on the books, which puts me at the same spot I was before, but it lets me see that this was actually voided, and this was a journal entry form telling me that I had to do something to void the check, and then the memo is telling me it's voided the check. If I go back, I go to my report over here, run the report, then I can see that the 150 is back on the books, and our net income should tie out for the prior period. Now I'm going to do another journal entry in the current period to do the adjustment in the current period so that I can actually write this amount off in the current period instead of messing up the prior period. So I'm going to go back on over and say, okay, now let's do another journal entry, and I'm going to imagine this happens on let's say 01/01/26, because I'm going to imagine the current year is 2026 so we can see it. So I'm going to say the payee is going to be, let's just say Verizon again, and we're going to say to reverse void expense on 1/3/05, and this time it's going to be a deposit side of things for 150, and then the other side is going to go to, well, and then it's going to be on the deposit side of things, and the other side is going to go once again to the telephone. Okay, so let's enter that. So now what happens? All right, so now if I go back on over here to the balance sheet, let's change the date range again to 2026 now, and I'm going to run it for 3 years. So 2024, 2025, 2026. And so now I should have the same information in 2025, but in 2026 now we have the reversal. Let me refresh it again. So there's the reversal in 2026. So if I bring this back to 2025 and 2026, you can see here's the original one, and we voided it, then we put it back on the books to not mess up the prior period, and then we reversed it in the current year in 2026, right? So it's somewhat of a tedious transaction. And then if I go to the tab to the right and we do the same thing, I'm going to bring this out to 2026 and then run it. So now I can see down here that in 2025, we voided it and then put it back on the books. And then in 2026, it's been reversed, showing a negative amount, so that we're reversing the timing account in the current period rather than the prior period. And then we can see in here, let me refresh it again. So there's our journal entry here in the current period. Now, if I bring this back to 2025 and 26, then you can see what happened. We had it in there, then we voided it. We put it back on the books to not mess up the income statement for 2025. And then we reversed it in 2026 so that we can not have to go back and correct all of the reports that we did last year for income taxes and external reporting, but rather reversed it in the current period so that we don't have to do that, because that would be a pain to do. Let's go back. And so that's going to be the idea. Now, if I go back on over here, the next thing that we're going to have that will be an issue with this, if I go into the transactions, is the bank reconciliation. So if I go into reconcile, see if I can check this out real quick and say we're going to reconcile. Let's go. And then I'm just going to go into the checking account for, let's just say 010, like 12, let's say 01/31/26. Statement ending date, and oh wait, I want to put that here, 12. Oh, they're gonna make me use the calendar thingy. All right, calendar thingy. I'll say 2026 January, end of January 2026, and boom, and then let's check it out. And so in here, we're going to see then these transactions. So I have to check off all of these transactions, right? So we're going to see where are these 150 transactions. All right, so here they are, right? So we got the Verizons. So here's the voided one. So I can check it off. It's not going to mess me up because it's voided. And then I can check both of these off, which will cancel each other out. So they're not going to mess up our bank reconciliation. So we'll still have to check them off, but they're not going to mess us up. All right. So that's going to be the idea. And so we have to be that same concept. We have to be careful of anytime we mess up a prior period transaction. And now let's just touch on a few other places where that's possible that it could happen. If you go into your reports, anytime we have a subledger, such as let's go into like the expenses, and then go into the bills possibly, and look at the unpaid bills. Now let's imagine that you had unpaid bills here that add up to 1602. If I look at the balance sheet, we can see the balance sheet for accounts payable adds to 1602. So this is in essence the subledger. But what if we had bills in here that we don't think we have to pay anymore? We don't owe them, and they're just sitting in here. For some reason, there was a bill that was entered. We have to get rid of it. We have a similar kind of problem. I'd like to clean that up, but I'm skeptical. I'm scared to just delete the bill because that'll impact the expense that I recorded. So we want to make sure that if we remove the bill somehow, we do it in such a way that it doesn't mess up net income in the prior period, but reverses net income in the current period. Similarly, if you had the sales side and we had invoices, all sales invoices, let's say. So now we have receivables that people owe us, and we're looking for the invoices. This is in essence the subledger for the invoices. I don't have it tied out right. It doesn't give us the total right here, but the idea would be then if I have collection and I'm not going to collect on the invoices, then I have to write them off in some kind of way that again affects the current period and not the prior period. Similarly with inventory, if you had an inventory subledger and there was inventory, on the books or something was different on the inventory, then again, you don't want to delete transactions or something like that. You want to record things in basically the current period. So those are where those similar kind of concepts will apply out. All right.